Welcome back to Talk Tickers. This is the show for experienced investors where we try to strip away the fluff and get straight to the numbers, the narrative, and the noise of earnings season. I am your host, and today is Wednesday, February 25th, 2026.
And I am joining you from the data desk.
Yeah.
It's really good to be here today.
We have a massive deep dive for you today because the market is currently trying to digest, or honestly, maybe I should say trying not to choke on a total beast of a print from the Latin American giant MercadoLibre.
Ticker symbol MELI.
Right, ticker MELI. And if you are looking at your screens this morning, you are seeing a sea of red for this specific name.
It is ugly out there.
Yeah.
We're seeing a classic Wall Street standoff playing out in real time. Because this isn't just a simple miss, it's a philosophical brawl between what the algorithms want today and what the company's actually building for tomorrow.
It really is a brawl. I mean, on one side, you have management delivering absolutely monster top-line growth. The revenue numbers are just staggering. But then on the other side, you have investors who were, desperate for profit realization. And instead, they got a bill for aggressive reinvestment.
Exactly. The central tension of this deep dive, and really the tension of the entire stock right now, was simple. How does a company deliver 45% revenue growth, beat top-line expectations by nearly $300 million,
and still see its stock price plummet over 10% in the immediate aftermath?
Right. It's a brutal reaction. I mean, the stock dropped from around $1,922 at the close yesterday down to hovering around $7,720 today.
That is a significant haircut.
Yeah.
That's billions in market cap just vaporized in minutes.
It is. It's a complete reset of expectations. And our mission today is to break down exactly why that happened. We're going to dig into the margin compression, the credit risk, and those hidden growth engines. Because while the price action says sell, the operational metrics might be saying something very, very different.
And make sure you stick around until the end because we have a really interesting not financial advice segment today. We've cooked up a trade idea involving the new China to Latin America logistics corridor.
We're calling it the Silk Road Arbitrage.
A Silk Road Arbitrage. You won't want to miss it. But first, let's just get into the hard numbers. Give us the snapshot.
All right, let's look at the headline financials for Q4 2025. Revenue came in incredibly hot, $8.76 billion.
Wow.
Yeah. The consensus was sitting around $8.47 billion, so that is a massive beat, and it represents 44.6% year-over-year growth.
Let's just pause on that for a second. 45% growth. We are talking about a company that is already the largest e-commerce player in Latin America. Usually by the time you reach this scale, the law of large numbers kicks in and you slow down to 15, maybe 20%.
If you're lucky.
Right, but 45%, that is startup speed.
It is exceptional momentum. It totally defies the gravity of their size. However, the pain and the reason for this massive sell-off today is entirely on the bottom line.
Right.
GAAP diluted EPS came in at $11.03. The street was looking for $11.43.
So a 40-cent miss.
A 40-cent miss.
And in this market, a 40-cent miss on a stock trading at these kinds of multiples is just unforgivable.
Precisely. And that miss is driven entirely by margins. Operating income was $889 million. That puts the operating margin to 10.1%. Now, if you compare that to the 13.5% they posted the previous year.
That's significant compression.
Very significant.
Yeah.
We are talking about a 340 basis point drop. That is what the algorithms and the analysts are reacting to today. They see margins going the wrong way, and they just hit the bid.
But if we look past the P&L for a moment, the operational metrics, the flywheel stats, they look incredibly strong to me.
No, they are robust. Gross merchandise volume, or GMV, hit $19.9 billion. That's up 37% year over year. Total payment volume, TPV, was $83.7 billion, up 42%.
That TPV number is just massive, almost $84 billion flowing through their pipes in a single quarter.
And the user base backs it up, too. Fintech monthly active users reached about 78 million. That's up 27%. But the number that really jumps out, and the one we are definitely going to spend a lot of time debating today, is the credit portfolio.
Right.
It exploded to $12.5 billion. That is a 90% increase year over year.
90% growth in credit. I mean, that is aggressive. That is almost doubling the loan book in 12 months.
It is. And that aggression is exactly what we need to unpack. The immediate market reaction, that 10.5% drop, was accompanied by heavy volume. About 1.34 million shares traded today, which is well above typical sessions.
So it's not just a few retail investors panicking.
No, not at all. This signals a strong rotation of the shareholder base. The steady compounder folks are exiting, and a different class of investor is stepping in.
Okay, Let's dive deep into this. We really need to talk about the margin compression versus the exceptional momentum narrative. Why did margins take such a hit? Management mentioned a 5 to 6 percentage point impact. Break that down for us, because investing for growth is kind of the oldest excuse in the book for missing earnings. Is it real, or is it just sloppy cost control?
It's a totally fair caution. During the call, the CFO was very explicit about this. He didn't shy away from it at all. He basically listed the bill of goods they bought with that margin. And the biggest driver was logistics, specifically in Brazil.
This is the free shipping threshold change, right?
Exactly. In mid-2025, they made a strategic decision to significantly lower the threshold for free shipping. Now, let's think about the mechanics of this for a second. Previously, maybe you had to spend the equivalent of $30 to get free shipping. They lowered that drastically.
So I can buy, say, a cheap phone case or a basic t-shirt and just get it shipped for free.
Correct. And the logic there is simple. It's frequency. If you make shipping free for cheaper items, people buy more often. They stop treating MercadoLibre like a place for events, buying a TV or a new fridge, and they start treating it like a convenience store.
And did it work?
The data proves it worked spectacularly. Items sold in Brazil accelerated to 45% growth in Q4.
That is a massive acceleration. So they're basically buying frequency. They're training the consumer.
They're buying habituation. They want the user to open the app for absolutely everything. But, and here's the rub, shipping cheap items for free is very expensive. It eats into your unit economics immediately.
Because of the fixed costs of delivery.
Right. If I sell you a $10 item and pay $3 to ship it, my margins look terrible compared to selling a $100 item and paying that exact same $3 for shipping.
Right. The shipping cost as a percentage of the transaction value just skyrocket.
Exactly. However, management argues that this drives massive scale. And interestingly, they noted that unit costs in Brazil actually declined by 11%.
Wait, hold on. Explain that. How do unit costs go down if they are spending more on shipping subsidies? That sounds completely contradictory.
It does sound like magic, but it's just the physics of logistics density. Think of a delivery van driving through a neighborhood in São Paulo. If that van stops at one house on the block to deliver one package, the cost of the driver, the gas, the van maintenance, all of that is allocated entirely to that one single package. That is incredibly expensive.
Okay, I follow you so far.
But because volume exploded, remember that 45% increase in items sold we just talked about, that exact same van is now stopping at 5 houses on the block, or maybe delivering 3 packages to the exact same house.
Right.
The truck is fuller, the route is denser. So the cost per package to the company actually drops by 11%.
So they are getting more efficient operationally.
Highly efficient. But, and this is the key to the whole margin miss, they are choosing to give more than that 11% savings back to the customer in the form of the free shipping subsidy to drive even more volume.
I see.
They are effectively passing 110% of their efficiency gains directly to the consumer to win market share.
That is a really nuanced point that I think the headline algos just completely missed today. They aren't getting inefficient with their spending. They are getting hyper efficient, but they are spending all of the savings on customer acquisition.
Precisely. And the CFO's tone on this was totally unapologetic.
Yeah.
He explicitly stated they are not trying to optimize short-term margins.
Yeah.
None of this was an accident. They see a window right now to widen their moat specifically against competitors like Shopee or the Asian cross-border players, and they're taking it.
They are burning the furniture to heat the house because they want to own the whole neighborhood.
That's a great way to put it, yes.
So what else drove the margin compression? It wasn't just shipping.
No, 2 other big factors. First, let's talk about 1P versus 3P. 1P, or first-party sales, are growing significantly faster right now than 3P or third-party sales.
We hear these terms thrown around a lot in retail earnings, but let's make sure everyone listening can visualize the actual difference here.
Sure. Let's break it down. 3P is the classic eBay model. You, as an independent seller, list a toaster on MercadoLibre. You sell it for $50. MercadoLibre takes a commission, maybe $5. They record $5 of revenue.
Right.
Their margin on that $5 is extremely high because they didn't have to buy the toaster, store the toaster, or take the inventory risk.
That's pure platform economics, high margin, asset light.
Exactly. Now, 1P is the traditional Amazon retail model. MercadoLibre buys the toaster from the manufacturer themselves for $40. They store it in their own warehouse. They sell it to you for $50.
Okay.
Under 1P, they record the full $50 as top-line revenue. But they have a cost of goods sold of $40. So their gross margin on that transaction is much, much lower.
So when 1P grows faster than 3P, your top-line revenue explodes because you're booking the full $50 value of the item instead of just a $5 fee, but your margin percentage naturally compresses.
Exactly. It's an optical margin compression driven by business mix. And that is exactly what is happening right now. They're pushing 1P heavily to control the inventory, ensure availability, and speed up the shipping times. It makes the customer experience significantly better, but it hurts the margin percentage on the spreadsheet.
And what was the second factor?
The credit card provisioning. And this is the truly controversial one. They issued nearly 3 million new credit cards in Q4 alone.
We'll get much deeper into the credit side in a minute, but I want to stay on commerce for just one more second. Because looking at the geography, Brazil and Mexico are both growing GMV at roughly 35%. That is relentless growth for markets that are supposedly maturing. I mean, how much bigger can e-commerce really get in Brazil?
It really challenges the whole idea that these are mature markets. Management keeps hammering the point that Latin American e-commerce is still vastly underpenetrated compared to the US or China. In the US, e-commerce penetration is somewhere around 20 to 25% of total retail. In LATAM, depending on the specific country, it's closer to 10 or 15%.
So the runway is still massive.
The runway is huge. And they are sprinting to capture the next wave of adopters, people who are just coming online financially or who are just starting to trust online delivery in more rural areas.
It really feels like they're playing a completely different game than the investors who just want a steady dividend or a stock buyback. This is still a wartime CEO mindset.
They absolutely are.
Yeah.
And that is where the friction is today. Investors look at a print, see margin miss, and they think incompetence. Management sees market share victory and thinks dominance.
Okay, let's transition and move to segment 2, because this is where the real risk and arguably the real long-term reward seems to be hiding. The fintech explosion and the credit risk debate. You mentioned 3 million new cards issued in Q4. That is a blitz.
It's a massive acceleration. They were up from 1.5 million cards in Q2, so they essentially doubled their issuance rate in 6 months. They are flooding the zone, and the strategy is very clear. They want to be the principal bank for their users.
Now, principal bank is a very specific term in finance. It means being the car at the top of the wallet.
Exactly. They don't just want to be a digital wallet you use to buy a MercadoLibre package once a month. They want to be the card you use for groceries, for gas, for your Netflix subscription, for absolutely everything. Because if they get that, they get the data. Yeah. And they get the interchange fees on every single transaction in your entire financial life.
But with that speed comes danger.
Yeah.
Especially in Latin America, we are talking about unsecured consumer lending in economies that are historically very volatile. What are we seeing in terms of asset quality? Are these loans actually performing?
Well, this is exactly where the bears are sharpening their claws today. Overall delinquency is sitting at a 7.6%.
Okay.
But the scary metric, the one that management had to highlight, was that the 15 to 90-day early delinquency bucket ticked up in Q4.
Yeah, that's the canary in the coal mine. Early delinquency almost always turns into late delinquency, which eventually turns into a write-off.
Usually, yes. That's how the cycle works. However, management had a very strong defense for this. Osvaldo Jimenez, the fintech president, argued this is a calculated risk. He essentially came out and said, we know these people are riskier. We are deliberately approving riskier profiles people we probably would have rejected a year ago.
Wait, hold on, though. Why would any company deliberately approve people they know are likely to default? That sounds like subprime lending 101. That's how financial crises start.
It sounds dangerous, but it's about the math. They are pricing the spread higher to compensate for the default risk. If I know there's a 10% chance you default, but I charge you an interest rate that covers that 10% risk plus a healthy profit margin, I can still make very good money on that cohort of loans.
Right.
They claim that their NIMLO, which stands for net interest margin after losses, is actually improving or remaining very healthy despite the higher defaults.
So they are charging aggressive rates.
Very aggressive. You have to remember, this isn't a 5% APR world like a mortgage in the US. In Brazil, consumer credit card interest rates can be astronomical.
Yeah.
You're talking triple digits annually in some revolving credit cases. So the spread they have to work with is massive.
But that requires the economy to actually hold up. If Brazil goes into a deep recession or if unemployment spikes suddenly, those calculated risks stop paying entirely. And it doesn't matter what your interest rate is, you cannot collect money from someone who has no money.
That is the systemic risk. And that is exactly why the provisioning is so high on the income statement right now. Let's explain the accounting here because it is absolutely crucial to understanding why the stock is down today.
Yes, please do.
Under IFRS 9 accounting standards, when you issue a credit card and give someone a line of credit, let's say you give them $500, you have to estimate the expected credit loss for the next 12 months on that specific line of credit. And you have to book that expected loss immediately on day one.
Before they even spend a single dollar.
Before they even swipe the card for the first time. You take the hit to the P&L instantly. So this creates a well-known phenomenon in lending called the J-curve.
Right.
When you are growing your portfolio incredibly fast, like 90% year over year fast, you are stacking up massive upfront losses on the income statement today for loans that haven't even had time to generate interest revenue yet.
So the profit looks artificially low right now because you are essentially prepaying for future bad debt.
Exactly. You pay the loss today, but you collect the interest revenue over the next 12 to 24 months.
Yeah.
Management stated very clearly that the older cohorts, the cards they issued 2 or more years ago, are highly profitable in Brazil right now. The loss on the P&L today is coming almost entirely from the cost of acquiring the new users.
So if they just stopped growing their credit business today, their profit would technically explode tomorrow.
Theoretically, yes. If they stopped issuing new cards, the day one provisions would vanish, and the interest income from the existing $12.5 billion book would flow straight through to the bottom line. But because they're keeping the pedal to the metal, the upfront costs completely mask the underlying profitability.
There's also a really interesting synergy they mentioned regarding deposits, right?
But deposit flywheel, yes. They are seeing massive growth in interest-bearing accounts on Mercado Pago. And the internal data shows that users who hold a cash balance with them interact significantly more with the commerce marketplace. They buy more items, they use the debit card more often. It makes the user incredibly sticky.
So the bank funds the commerce, and the commerce feeds the bank. It's a closed loop.
That is the dream scenario. But let's be real about the market's skepticism here. You have established fintech players like Nubank, Inter, plus massive traditional banks like Itaú and Bradesco, all fighting for the same consumers. The average Brazilian consumer is becoming highly levered. They have 3, 4, maybe 5 credit cards. It becomes a game of musical chairs when the music stops.
And MercadoLibre is betting that because they have the shopping data, they know you buy diapers every Tuesday or you just bought an expensive television. They have a far better view of your true solvency and life stage than the traditional bank that only sees your monthly paycheck hit a checking account.
That is their secret sauce, the alternative data. But the broader market is looking at that $12.5 billion unsecured credit book and getting very nervous. If the Latin American credit cycle turns south, holding a $12.5 billion bag of consumer loans is a dangerous place to be. That is the uncertainty tax the stock is paying today.
It essentially turns MELI from a high-flying tech company into a bank, and banks get lower multiples.
Correct. Traditional banks trade at maybe 8 times earnings. Tech platforms trade at 30 or 40 times. If MELI starts being viewed as just a bank with a retail store attached, the multiple compression could be severe and lasting.
Okay, moving on to segment 3. This one flew under the radar for some of the generic financial media today, but I think it is actually huge. The China reveal.
This was a major confirmation on the call. Management officially confirmed they opened their first fulfillment center in China in December 2025.
Now, let's really unpack this. Why does a Latin American e-commerce company need a massive warehouse in China? Isn't the whole point of MercadoLibre that they are the local champions?
It is a brilliant defensive and offensive move against the rise of cross-border trade. Think about competitors like Shein, Temu, or AliExpress. They have been aggressively eating market share in Brazil and Mexico by shipping incredibly cheap goods directly from Chinese factories to the Latin American consumer.
Right, the $5 summer dress or the $3 phone charge.
Exactly. But the logistics of that cross-border model are usually very messy. It typically takes 15 to 20 days for a package to arrive. The tracking is terrible. And recently, Brazil introduced strict new tax rules, a program called Remessa Conform that requires import taxes to be paid at the point of purchase to speed up customs clearance.
So how does MercadoLibre having a warehouse in China change this dynamic?
By owning the warehouse in China, MercadoLibre becomes the primary consolidator. A Chinese seller can ship their goods directly to MELI's warehouse in Shenzhen, for example. MELI then handles the sorting, the the packaging, and most importantly, the first mile onto the cargo plane. They can consolidate thousands of individual consumer orders into a single, massive air freight shipment, which drastically reduces the cost per item.
So they're basically building their own bespoke DHL or FedEx pipe directly from China to LATAM.
Yes, and because they fully integrate with the local customs systems in Brazil, they can ensure all the taxes are calculated and paid instantly at checkout. So when that plane lands, the package flies right through the green channel of customs. Instead of waiting 3 weeks, maybe the customer gets their cheap item in 5 days.
That completely neutralizes the advantage of the pure play Asian apps. Because if I can buy that exact same $5 gadget on MercadoLibre, get it a week faster, and I already trust MercadoLibre with my credit card details, why would I ever download or use the other app?
That is the moat. It turns MercadoLibre into the primary gatekeeper for Asian goods entering Latin America. Instead of trying to fight the flood of cheap Chinese goods, they're just building the canal to control the flow.
And charging a toll on every single boat that passes through.
Exactly. It's pure infrastructure. And speaking of infrastructure, their logistics expansion didn't stop with China. They added 16 new fulfillment centers across Latin America in 2025 alone. The capital expenditure spend is very real. They are building a physical network of steel and concrete that is incredibly hard to replicate. You can copy an app source code in a week. You cannot copy 16 million square feet of optimized warehousing in a year.
They also touched on their new shipping logic, introducing variable rates based on weight and dimensions. Now, this sounds a bit boring on the surface, but tell me why it actually matters for the bottom line.
This was introduced in January 2026. It's a move to de-average their costs. Previously, their shipping pricing might have been a bit flatter across different items. Now, if you are shipping a kayak versus shipping a smartphone, the pricing and the subsidy will be much more granular based on the exact cubic volume it takes up in the truck.
So they stop losing money on bulky, cheap items.
Right. If you buy a giant plastic storage tub that costs $5 but takes up a massive amount of space in the delivery van, they were almost certainly losing money on that specific shipment. Now, the algorithm adjusts the shipping fee or caps the subsidy dynamically based on the geometry of the item. It effectively creates a floor for their logistics margins going forward.
Let's talk about segment 4, the silent growth engine, AI and advertising. We talk about AI a lot on this show, and usually, let's be honest, it is just corporate buzzwords. Is it actually doing anything tangible for the bottom line here?
It is really starting to. Let's look at the ad business first. Advertising revenue was up 67% on an FX neutral basis. That is enormous growth. And you have to remember, advertising is high margin revenue. It is almost pure profit.
This is the Amazon playbook playing out again. Amazon makes very little actual profit selling you a physical book. They make an absolute fortune charging the publisher of that book to advertise it at the top of your search results.
Precisely. Retail advertising margins are typically 70 to 80%. That cash flow drops straight to the bottom line, and that is exactly what subsidizes the heavy logistics spend we discussed earlier. That ad money is what actually pays for the free shipping we talked about in segment 1.
67% growth in ads is wild. What is actually driving that? Is it just more eyeballs on the app?
It's better tech. They recently launched a budget orchestrator tool that allows sellers to move their ad spend fluidly between different campaigns. And their new AI-driven bidding algorithms are drastically improving the return on ad spend, or ROAS, for the merchants.
Explain that ROAS connection for us.
Sure. If I am a seller on the platform and I spend $1 on ads and get $5 in sales, I might spend a little bit of money on ads. It's okay. But if MercadoLibre's AI gets smarter, and now for every $1 I spend, I get $10 in sales, I am going to dump my entire marketing budget into their platform. The better the AI targeting becomes, the more share of wallet they steal from traditional ad platforms like Google or Facebook.
And what about on the operational side? Is AI cutting costs?
This is where the long-term margin story gets fascinating. The Mercado Pago Assistant, their proprietary AI agent, is now handling over 9 million customer conversations.
And the resolution rate on those?
87% resolved without human intervention.
That is a staggering number. 87% of people calling or chatting with support for a banking or e-commerce issue never have to talk to a human being.
Think about the long-term OpEx implication of that. As they scale from their current base to maybe 100 million or 200 million active users over the next decade, they do not need to scale their customer support call centers linearly anymore. In the past, to double your users, you essentially had to double your support staff. Now, you just spin up more server instances. Customer service costs should effectively plummet over time as a percentage of overall revenue. That is a massive structural advantage.
Management also had a very interesting take on agentic commerce, this idea that soon AI agents will just do all the shopping for us.
They did. There is a real fear in the retail industry right now that in the near future, you'll just tell your phone's personal AI, buy me a toaster, and the AI will scan the entire web, find the absolute cheapest price, and buy it silently. This would completely commoditize brand name marketplaces like MercadoLibre.
Right, because the brand loyalty disappears. The AI doesn't care about the MercadoLibre logo. It just hunts for the lowest price tag anywhere on the internet.
But MercadoLibre's view is that they will actually own the winning agent inside their own app. Because they own the physical fulfillment, the trucks, the warehouses, and the payment rails, they believe their AI agent will simply be the most effective one.
So the argument is essentially, my AI can actually guarantee the toaster gets to your house tomorrow morning because I own the delivery truck. The generic web AI can only browse the internet. It can't guarantee physical delivery.
Exactly. Physical assets matter in the real world. You cannot AI your way out of delivering a physical package in the middle of the Amazon rainforest. You need a van, and Amial has the vans. They are betting that vertical integration always wins over a pure software layer.
Let's zoom out for the broader investor context. The stock is down 18.7% over the last month. The NASDAQ Q over that same period is effectively flat. This feels like a major decoupling from tech.
It is a decoupling. The macro view is that investors are deeply fatigued by the investment cycle. This happens with almost all high-growth companies. They go through phases of harvesting profit where margins go up and stock prices soar, and phases of planting seeds where margins go down, spending goes up, and investors panic. MELI is clearly in a heavy planting phase right now.
It reminds me again of the Amazon comparison. We keep going back to it, but it fits so well.
It is the classic parallel. Look at Amazon in 2014 or 2015. They were aggressively sacrificing near-term profit to build out prime logistics and AWS data centers. Wall Street absolutely hated it for a few quarters. Countless articles were written asking, will Amazon ever make real money? And then the infrastructure matured, the profits turned on like a geyser, and the stock went up 10x.
MELI is asking us to believe they're in that exact 2015 moment, sacrificing profit today for logistical dominance and banking dominance tomorrow.
But there is a trust me tax associated with that. When you miss earnings by 40 cents because you are heavily provisioning for consumer credit losses, you are asking investors to blindly trust your internal underwriting models. And right now, the market is in a show me mood, not a trust me mood.
Especially with the credit piece. Because it's one thing to trust Jeff Bezos to build a warehouse efficiently. It is another thing entirely to trust a tech company to underwrite billions in unsecured loans to consumers in Brazil.
That is the key distinction. The risk profile of a bank is fundamentally different than a retailer. And that is why we saw sell-side analysts reacting the way they did today. Wedbush, for example, cut their price target from $2,600 down to $2,400.
But they kept the outperform rating.
Right, that's key. Yes. It signals reset of near-term expectations, acknowledging the margin pressure and the EPS miss, but not a broken core thesis. They still believe in the long-term story. They just think the next 6 months are going to be incredibly choppy.
So what are the specific catalysts to watch now? If I'm holding this stock, what am I looking for next quarter?
3 main things. First, we absolutely need to see stabilization of those NPLs, the non-performing loans. If that 15 to 90-day early delinquency bucket keeps ticking up next quarter, the stock will go lower, period. That will signal to the market that the underwriting model is fundamentally broken.
Okay. Number 2.
Evidence that these millions of new credit card users are actually sticky. We need to see TPV per user go up. We need to see hard data that the people getting these new credit cards are actually using them to buy things on the MercadoLibre marketplace, proving that ecosystem synergy thesis.
And number 3.
Any future guidance? Management did not give explicit margin ranges for 2026, which clearly signals they want the flexibility to keep spending heavily if they see the opportunity to take more market share. If they come out next quarter and say, okay, we're done spending, margins will expand, the stock will pop, but honestly, I wouldn't hold my breath for that.
So expect continued severe volatility.
Absolutely. This is not a stock for the faint of heart right now. It is a true battleground stock.
All right. That brings us to the part of the show everyone waits for. This is our not financial advice segment.
Disclaimer time. We are not financial advisors. This is for entertainment and educational purposes only. Please do your own diligence. We are 2 voices doing a deep dive, not your personal portfolio managers. Do not trade based purely on this segment.
Now that the compliance lawyers are happy, I'm looking at this MELI drop today, and I am looking at their underlying strategy. They are basically building an impenetrable wall around Latin American commerce. So Here is the pitch. I call it the Silk Road arbitrage. It is a long-short pair trade.
Let's hear it. This sounds a bit exotic.
The trade is this: long MercadoLibre and short a basket of pure-play Brazilian banks. Think of shorting incumbents like Itaú, Bradesco, or maybe a regional bank ETF like EWZ if you want broad exposure, though that does carry commodity risk too. So let's stick to shorting the specific banks.
Okay, walk me through the logic here. Why short the banks? They're historically very profitable machines.
They are, but they are dinosaurs. MELI is aggressively stealing the principal bank relationship right out from under them. They are issuing credit cards at a rate the incumbents simply cannot match without taking on terrible risk. They're offering high-yield accounts that are systematically draining retail deposits away from traditional savings accounts.
True. The user experience on the Mercado Pago app is light years ahead of most of the legacy banking apps down there.
Exactly. And most importantly, MELI has the data advantage. They know what you buy. They know if you are solvent before you even apply for the loan. If MELI wins this credit war, the traditional banks lose their most profitable market share, and their margins get severely compressed as they are forced to compete on interest rates just to keep deposits.
So you're betting on the tech disruptor against the legacy incumbents. Classic pair trade.
Yes. But here is the kicker: the China Fulfillment Center. That is the infrastructure play that makes this asymmetrical. It turns MELI into the absolute gatekeeper for Asian goods. Now, if the Brazilian economy slows down and goes into a recession, what happens to consumer behavior? People stop buying expensive local brands and they trade down. They start buying cheap Asian goods to save money.
The trade-down effect. Yeah. It happens in every recession.
Yes. And MELI captures all of that trade-down volume because they own the China logistics pipe we talked about, the traditional banks. They just get stuck holding the bag with the bad loans from the struggling local retail businesses and the unemployed consumers.
It's a very aggressive hedge. Yeah. You are essentially betting that MELI's alternative data allows them to cherry pick the good borrowers while the traditional banks are left suffering from adverse selection, essentially getting stuck with the limits.
Correct.
But what if the entire credit cycle just violently implodes? What if Brazil goes into a massive, deep recession?
Well, that's the risk profile you have to accept. If the credit cycle totally implodes, MELI's new $12.5 billion loan book hurts them just as much as it hurts the banks. The correlation might be closer than you think in a total crash scenario. In a true washout, everything goes down.
But in a muddle-through scenario where maybe Brazil just limps along with 2 or 3% GDP growth, MELI likely captures all the incremental growth while the banks just stagnate.
Exactly. It's a bet on rapid market share transfer, hedged by the fact that if the economy tanks, the short side of the trade the bank should pay out enough to cover your MELI equity losses.
It's sophisticated. High risk, high reward. Kind of perfectly mirrors the stock itself right now.
To wrap this deep dive up, MercadoLibre delivered a monster revenue beat today, but completely failed the margin test in the eyes of Wall Street. The core business is growing at an incredible 45%, but the cost of funding that growth, the shipping subsidies, the credit provisions, is rising rapidly.
And management remains defiant. They are focused entirely on the 5 to 10-year horizon. They are leveraging AI and massive logistics investments to build an unassailable moat. The market currently hates the uncertainty of the credit expansion, and frankly, they are right to be skeptical. It is a huge, huge risk.
But for the long-term believer, the disappointment drop today might look like an absolute gift in retrospect if the new credit cohorts mature profitably exactly as they have in the past.
That is a big if. But that's exactly why we play the game.
And before we sign off, I want to leave you with one final provocative thought that we didn't cover. With 16 new fulfillment centers and a new pipeline from China, what happens in 5 years if MercadoLibre decides to white label their delivery network? What if they become the AWS of physical logistics for all of Latin America, delivering packages even for their competitors just to utilize the spare capacity? That would completely rewrite the valuation models we are looking at today.
Now, that is a massive idea to chew on.
Keep your eyes on the ticker, and we will catch you on the next print.
Thanks for listening.